We are reporting on the investment banking news from January 17th through January 23rd. The people reporting in this order are Jeremy Kohler, Michael Kelly, Ryan Michael, Amanda Young, and Nathan Thompson. Recent news on equity financing is with SurveyMonkey, which is an internet-based company that makes it simple to create web surveys. It also offers tools to design surveys, collect responses, and analyze data. SurveyMonkey has recently raised approximately $400 million in equity financing and $350 million in debt financing to give its shareholders some returns. This is one of the largest capital raises by a privately held U.S. internet company. Other news in investment banking comes from Brazil, from BTG, which is a Brazilian investment banking company. They recently have predicted that in 2013 there will be a merger surge of 40% from last year. Economic growth in Brazil is the largest emerging market after China. It is predicted to grow by 3.2% this year as compared to last year's growth of less than 1%. Mergers will surge in 2013 as the economy rebounds and concerns about the antitrust rules fade. Marco Goncalves, head of mergers and acquisitions at Sao Paulo-based bank, said, "The pipeline now is the biggest I've had seen since I have started at BTG in the beginning of 2009. They believe that the retail and electric power industries will see the most activity this upcoming year."
So for a brief overview of economic conditions, U.S. stock rose, sending the Dow Jones Industrial Average to a 5-year high, as House Republicans plan to vote this week on a temporary increase in the debt limit. Treasury 10-year notes rose for a second week for the first time since November, as the absence of progress toward resolving the impasse on raising the U.S. debt ceiling sustained demand for the safest securities. The benchmark securities advanced last Friday for the fifth time in 6 days, as the Federal Reserve purchased $8.797 billion of U.S. government securities in 5 operations as part of its effort to restore growth in the world's largest economy. House Republicans are weighing a short-term extension of the government's borrowing authority to spur President Barack Obama into negotiations on spending cuts. The Treasury will sell $15 billion of 10-year inflation-protected securities this week. News regarding investment banking firms. Citigroup Incorporated, the third largest U.S. bank, cut investment bankers' bonuses by 10% to 20% globally after a revenue slump, according to people with knowledge of the matter. Morgan Stanley, the bank that's deferring all bonuses to top earners, set aside $6.65 billion in 2012 to pay investment bank employees, a 7.6% decline from a year earlier. Morgan Stanley joins Goldman Sachs and J.P. Morgan Chase & Co.'s corporate and investment bank in setting aside a smaller portion of revenue to pay as the world's biggest bank seeks to pare costs. New York-based Morgan Stanley is cutting 1,600 jobs in its investment bank.
News on tax developments. For the first time in 20 years, taxes are going up for the rich. Households making more than $450,000 will pay a higher top marginal income tax rate of 39.6%, a higher estate tax rate of 40%, and also a higher 20% rate on dividends and capital gains. According to the Tax Policy Center, 2/3 of Americans will pay higher taxes in 2013. The European Union finance ministers are expected to give their approval at a meeting in Brussels, allowing Germany, France, Italy, Spain, Austria, Portugal, Belgium, Estonia, Greece, Slovakia, and Slovenia to get the go-ahead on Tuesday to start working on a financial transactions tax on all financial market transactions. This is likely to unsettle banks and investment houses, but please voters and could raise much needed revenue. It is estimated that the tax could raise up to 20 billion euros a year. Under the European Union rules, a minimum of 9 countries can cooperate on legislation without all member states, using a process called enhanced cooperation, as long as a weighted majority of the European Union's 27 countries give their permission. Germany and France decided to push ahead with a smaller group after efforts failed to impose a tax across the whole European Union and later among just the 17 Eurozone states. Sweden warned that the levy would push trading elsewhere. Many are concerned that there is growing risk that Britain could even leave the European Union. Britain says that London, the region's largest financial center, would be affected and as a result will not adopt the tax. If either the buyer or seller in a trade is based in one of the countries imposing the tax, the levy can be imposed regardless of where the transaction takes place. One proponent believes that the tax can tackle activity many deem speculative, such as high-frequency trading, by imposing a charge on every split-second deal. One expert said the tax is misguided. It is estimated that there will be a tax of 0.1% on stocks and bonds and 0.01% on derivatives.
On to the global scene. The Royal Bank of Scotland Group is considering splitting its investment bank into 2. The splitting can go through if its current head, John Hurricane, leaves due to allegations towards the company of their knowing and manipulating several rates. The deal is said to be coming to a settlement within the next few weeks. The split would be separating its market business from its international banking operations. The governor of the Bank of Hungary has stepped down, but has not yet appointed a new one. When he left, he did so with a warning towards the government, saying that they should stop relying on taxes and other fiscal policies because it could lead to a sinking farther of the currency. This week, India increased the import tax on gold and platinum from 4% to 6%. This is done in an effort to cut demand for the commodity. Gold is India's second most important commodity by value. The amounts imported have resulted in a current account deficit and forced the local currency down 3% in 2012. The government is trying to flip this trend and decrease imports of gold. India has also begun to enforce production and export bans in some of its iron ore producing regions. Iron ore is one key ingredient in making steel, so the decrease in the international supply has driven the prices through the roof. There is a rising food demand in Asia, and some companies are trying to capitalize on that. BlackRock Incorporated, the world's largest money manager, is showing interest in buying Australian dairy and grain handling stocks. Demand for textile fiber is also on the rise in Asia, cotton in specific. Louis Dreyfus is one of the world's largest commodity traders and is looking to cash in by partnering with Nimoy Cotton Cooperative Limited, which is one of Australia's largest cotton farmer cooperatives. They will work together to market producers' output of cotton. When the announcement was made, Nimoy's shares jumped to 25%.
Continuing the news on Dell's PC leverage buyout transaction, Dell may depend on cash forward outside of the U.S. by bringing in foreign cash. Dell may also be able to avoid income tax. Michael Dell's plan to take his computer company, Dell, private may depend on whether he's able to use one of the company's most valuable assets, which is as much as $14.2 billion of cash and bonds outside the U.S. By going private, Dell will be able to diversify away from its struggling PC business without the scrutiny of the public markets. Since Dell's market share fell from 12.2% to 10.2% during the fourth quarter. Bloomberg estimates the buyout as the largest of a tech company since 2007 and the largest in the computer industry since HP bought Compaq. With the deal being massive, reports speculate that Silver Lake management could be close to lining up nearly $15 billion for the Dell buyout. Silver Lake will be joining forces with RBC, Credit Suisse, Barclays, and Bank of America to put the transaction together. There's new speculation that Oracle could buy Dell, and Oracle has over $33.6 billion in cash. And this will enable Oracle to compete against HP, not only in the server business, but now in computers. And there's also news that Microsoft Corporation is in discussions to invest between $1 billion to $3 billion in a buyout of Dell. Deutsche Bank, Germany's biggest bank, was asked by the nation's financial regulator BaFin to simulate a split of its consumer banking and trading businesses. Regulators are toughening rules on banks to prevent a repeat of the taxpayer-led bailouts of 2008. The European Union, in an October report, called for banks to put their trading and deposit-taking activities into separately capitalized units. A hard split of the retail units from the trading activities would strongly increase funding costs in the investment bank, said Philip Hassler in analysis. And a French finance minister introduced a bill in December designed to force that country's largest bank to fence off proprietary trading activities in dedicated units. This would also forbid banks from holding stakes in hedge funds and limiting high-frequency trading and commodity speculations. The changes are milder than those proposed in the European Union and UK, as the governments seek to preserve a universal model that combines consumer lending with corporate and investment banking. An artificial split would put a huge burden on society and harm clients, the Dutch Bank Co-Chief Executive Officer Ashu Jain said at an evening in Germany yesterday. He said, "This would solve a problem that doesn't exist."